If you're seriously thinking about renouncing U.S. citizenship, there's one part of the process that stops most people before they even start. It's called the exit tax. The rules are strict, the dollar amounts are big, and the traps inside the calculation catch even wealthy, well-advised clients off guard. Today, I'm going to walk you through exactly what the exit tax is, who has to pay it, how it's calculated, and the specific ways successful expats plan around it before they renounce. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and I've been running an international tax firm ever since. My team has helped hundreds of Americans renounce U.S. citizenship the right way, and the exit tax planning is where most of that work happens. We'll cover what the exit tax actually is, the 3 tests that determine whether it applies to you, how the deemed sale calculation works with a real example, the retirement account trap most people miss, and the planning moves that can legally reduce or avoid it. Here's the plain English version. The exit tax, technically called Section 877 of the tax code, treats you as if you sold every asset you own the day before you renounce U.S. citizenship. Not if you want to. Every stock, every property, every private business interest, every position in your portfolio gets marked to market. The IRS calculates the gain on each asset as if you sold it at fair market value that day. Then they add it all up and they tax you on the net gain. This is why the exit tax is called a marked to market tax. Nothing actually gets sold, but you owe tax as if it did. For 2026, the first $910,000 of net gain is excluded. Anything above that amount is taxable at a normal capital gains rate. So for most people renouncing, that means a rate of around 23.8%, including the net investment income tax. But the tax only applies if you're what the IRS calls a covered expatriate, which brings us to the 3 tests. Meaning any one of these 3 tests puts you in exit tax territory. Miss all 3, and the exit tax doesn't apply at all. Test 1, the net worth test. If your total net worth is $2 million or more on the day you renounce, you're a covered expatriate. This threshold has not changed in nearly 2 decades. It's not adjusted for inflation, so a $2 million net worth in 2008 was substantial. A $2 million net worth today is a paid-off home in a good neighborhood plus a decent retirement account, which means the net worth test is catching more middle-class Americans every year, not just the wealthy. Test 2, the income tax liability test. If your average annual U.S. federal income tax liability for the last 5 years before you renounce is over $211,000 for 2026, you're a covered expatriate. This is the tax, not the income. So to hit this, your taxable income generally needs to be in the $600,000 range or higher for 5 straight years. This test tends to catch high-earning professionals, executives, and successful business owners. Test 3, the compliance test. You have to certify under penalties of perjury on Form 8854 that you've been fully tax compliant for the last 5 years. You filed every tax return, you filed every FBAR, you've reported every foreign account. If you can't certify that, you're automatically a covered expatriate regardless of your net worth or income. This one catches people who moved abroad years ago and stopped filing because they thought they didn't have to. If they renounce without fixing that first, the exit tax hits them even if their net worth is modest. Meaning even one of these 3 tests puts you in exit tax territory. Miss all 3 and the exit tax doesn't apply. Now, let's look at how the actual calculation works with a real example, because the numbers are easier to understand when you see them run. Let me walk you through a client scenario. A client net worth is $3 million. That already trips the net worth test, so they're a covered expatriate. Their assets break down like this: $500,000 in cash, $1 million in stock with a cost basis of $250,000, and $1.5 million real estate with a cost basis of $1 million. Here's how the calculation runs. The cash is worth $500,000 and has no gain. The stocks have a gain of $750,000, the difference between the fair market value and the cost basis. The real estate has a gain of $500,000. So total net gain, $1.25 million. Subtract the 2026 exclusion of $910,000, you're left with a taxable gain of $340,000. At roughly 23.8% capital gains rate, the exit tax bill on that gain is around $80,000. Not the entire net worth, not even close to half, just the tax on the gain above the exclusion. For clients with modestly appreciated assets, the exit tax is often much lower than they expect. For clients with highly appreciated assets, especially early startup equity or long-term real estate, the number can be enormous. It all depends on your basis. But there's one category of assets where the exit tax works completely differently. And this is where most people get blindsided. Retirement accounts don't get the $910,000 exclusion. IRAs, Roth IRAs, HSAs, 529 plans are treated as if the entire account balance was distributed to you the day before you renounce. And that distribution is taxed as ordinary income at your marginal tax rate. Think about what that means. If you have a $500,000 IRA the day before you renounce, then that entire $500,000 is treated as ordinary income. You could easily owe $150,000 to $200,000 in federal tax on that alone, on top of any exit tax on your other assets. One thing to note is that I did not mention 401ks. They are not required to be automatically distributed as a covered expatriate. However, a 30% withholding tax would be applied later when they are distributed. This is a much better scenario. So if you're looking to renounce, don't roll over your 401k into an IRA. For clients with substantial retirement account balances, the retirement account rule often creates a bigger tax bill than the mark-to-market rule does on everything else combined. This is why the standard advice on retirement accounts before renunciation is different than the standard advice on other assets. It's a separate calculation, a separate rate, and a separate strategy. Now, all of this sounds expensive. Here's the good news. There are specific legal planning strategies to reduce or completely avoid the exit tax before you renounce. Here are the three main strategies. Strategy 1, get under the $2 million net worth threshold through gifting. The 2026 lifetime gift and estate tax exemption is $15 million per person, which means you could gift substantial assets to a spouse, to children, or to trusts, well below the exemption limit without you triggering gift tax. If you strategically gift assets down to under $2 million in net worth before renouncing, you could avoid covered expatriate status entirely on the net worth test. The catch, you can't gift assets on the same year that you renounce, or the IRS treats them as still yours. So in practice, we recommend gifting at least 2 to 3 years before renunciation to avoid clawback risk. Strategy 2, fix the compliance problem before you renounce. If you've been out of compliance for years, the IRS Streamlined Disclosure program often lets non-willful taxpayers catch up on the past 5 years of returns and 6 years of FBARs with no penalties, just interest if you owe. This gets you compliant and lets you certify on Form 885A and takes the third covered expatriate test off the table. Strategy 3, optimize what you gift. The $910,000 exclusion applies to your total net gain across all mark-to-market assets, which means the assets with the highest built-in gains, like early stock grants, long-held real estate, appreciated crypto, are the ones you want to gift out before renunciation. Assets with low or no built-in gain can stay with you because they won't trigger meaningful tax anyway. Done well, these three strategies together can reduce a projected 6-figure exit tax to 0 for a lot of clients. Done wrong, they could trigger clawback rules, gift tax issues, and even make the situation worse. Bonus tip, remember that it's all about the valuation. They say valuation is more an art than a science, so in that case, be a Picasso. If you have non-liquid assets such as real estate, private company stock, startup investments, then you are allowed to take certain discounts on the value due to illiquidity or not being a majority shareholder, which is called a lack of control discount. The amount of the discount depends but generally I wouldn't consider going over 30%. If you want to use valuation discounts, I do suggest getting a valuation professional. Here's the honest summary. The exit tax is real, and it's significant if you're a covered expatriate. But for most people who plan properly, it's much smaller than the internet makes it sound. And for clients with substantial assets who plan well in advance, it can be reduced to zero or close to it. The people who get hurt by the exit tax are almost never the ones who worked with a professional before renouncing. They're the ones who showed up at the embassy, signed the paperwork, and figured out the tax bill afterwards. If you're not ready to renounce, the smartest move right now is making sure you're using the tools available to you as a U.S. citizen abroad. The biggest one is the foreign earned income exclusion. And the next video on the screen breaks down the exact ways Americans accidentally disqualify themselves from that. Watch that one next. And if you're seriously considering renouncing and want to optimize for that and what you owe for exit tax, the link below will get you on a call with our team. This kind of planning has to happen years in advance. So the earlier you talk to someone, the more options you have. Thank you.